Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Chartered Market Technician and Portfolio Manager. Thank you for joining this and April 27th Market Carver edition. We're going to talk about three things. We're going to hit some fundamentals and talk about valuation by sector. Oftentimes we're talking about the valuation levels of the overall market. So I want to take a deeper dive and look at underneath the hood of across the 11 sectors of the S&P 500. We're going to take a look at inflation and then natural gas. So we're going to start off with the changes in sector valuations. All right, so underneath the S&P 500 are 11 different sectors. It's a list that grows over time. Most recently, communication services was spun off from the technology sector. Real estate was spun off from financial. So this evolves over time. But what we could find is that the S&P 500 as a group, if you put all these together, in the way that they make up the S&P 500 right now, you would say that the S&P 500 is a bit overvalued relative to its long-term averages. Its forward price to earnings ratio, so the amount of price that we'll pay per share of the S&P 500 relative to its earnings right now is over 18. The longer-term average is closer to around 15, so a little bit of a premium there. However, if you look at these sector valuations, so the long vertical bar, that gives you a sense of what the range of the valuation has been over time. The solid dot tells us where we are right now, and then the horizontal blue line tells you for each sector what its specific average has been. So the long vertical, just a couple comments on it. The long vertical line, take a look at energy. That line was basically an infinite vertical line when energy earnings just totally evaporated during COVID. So there is some oddities that go along with certain sectors. We want to focus on how much the current dot is away from that horizontal blue line. And what I want to point out is the consumer discretionary and technology. So the second one from the left and the second one from the right. Both of those are substantially above their averages. And what's more to this is that those two are pretty big sectors of the S&P 500, especially technology, which by itself is over 1/4 of the value of the total index. So even though technology had a very difficult 2022, they still remain well above its long-term averages. So these metrics here are a very poor guide to what's going to happen next quarter, what's going to happen for the remainder of the year. But this set of data just by itself tells us that we want to continue to have patience with regard to those sectors. And it could take a multi-year process if they were to return to what is known as their long-term averages. So that doesn't mean that we won't from time to time be having technology stocks in the portfolio or discretionary ones. It just means the burden of proof is a little bit greater for those. So that's sector valuations. I want to shift the gear to inflation. We just can't seem to get this to go out of our purview. And I guess it's worth noting that it's not just here in the United States. So our Federal Reserve's got its hands full. They're going to meet again in May, and a lot's going to depend on how this data takes shape and how they view that it will take shape. But I think what we're missing from time to time is just how truly global this is. Andrew's got a great chart to really break that down to show we're not alone.
Yeah, for about 10 years, we haven't talked about inflation almost ever. And now it feels like over the last 12 months, it's all that we can talk about. And that's because it's been so important for the financial markets. As the Fed started to raise interest rates, they really were trying to get inflation under control. And that's what kind of introduced some of the volatility we've seen in both fixed income and equity markets. And as Adam said, this hasn't been just a domestic, a U.S. topic. We're seeing inflation last year started to rise across the globe: Australia, Europe, China, Japan, all over the world. We saw inflation start to rise, and with that, central banks across the globe also started to raise interest rates. And so, as we've started to see a lot of the banks, similar to the U.S. Federal Reserve, is kind of on this pace to where they want to raise maybe one or two more times and then hopefully pause, kind of see what the real impact of those hikes are before they have to either start raising again, hopefully not, or start cutting rates. And so that's what the market's expecting right now, is that, as Adam said, we're going to have another rate decision from the Fed in May. They're expected to do 25 basis points. And then the market generally believes that then they're going to pause and say, okay, let's see how the market digest all these rate hikes. Let's see what the data starts to look like over the summer, and then go from there. And that's kind of the tone that we're seeing a lot of central banks take. The problem is when we look at the current data for the US and internationally, inflation is still really high. And that's what this chart we brought today to show is looking at the different CPI, consumer price indexes, year over year for the US, UK, Japan, Canada, Europe, and Australia. And as you can see, these lines are still going from the right to the left and from the bottom and up, meaning inflation really hasn't come down a whole lot. Some of these lines have peaked back in 2022. Some haven't. Look at Japan, still making higher highs, still seeing data out of Europe that looks still pretty frothy for inflation. And US data, as we've talked about several times in our allocation meeting, certain components of it are sticking pretty high. And so what this data is telling us right now, and what the argument that Bank of America is making with this chart, they're the ones that made it, is that a lot of the Federal Reserves across the globe, including ours, are locking in higher inflation, meaning that if they are going to pause their interest rate hikes, they're doing so with inflation still pretty high. We have to remember the initial target for inflation was 2% here in the US. We're nowhere near 2% right now. Now, that doesn't necessarily mean we won't get there and this data could continue to soften. But if the Fed does pause, it still has a lot of gravity that's going to need to pull its inflation data down if the Fed's not going to do it itself. And so this is going to create kind of a pickle globally with this data still coming in hot, and the Federal Reserve's kind of shooting a lot of the bullets that they had planned to shoot to bring inflation down, and it really didn't do a whole lot to slow it. They have come down a little bit, but it's still pretty doggone high. Now, one of the other topics that we talk about when we talk about inflation, we talk about commodities. Commodities play a big part of that, and food inflation, energy inflation. And one of the markets that has come down quite a bit is natural gas prices. We saw natural gas rise a lot last year, and then it kind of turned on a dime and came down roughly about 70%. You can see on the chart here from 2020 through last summer, natural gas. We changed topics there. Natural gas had a really big run up, got up to just over $9, and now has come all the way back down to almost $2. Now, when we talk about commodities, we want to look at how is the market positioned? Are there a lot of people that are buyers, or are there a lot of sellers? And that's going to be obviously what's going to drive the price higher or lower. And from our analysis, we found there's a group of traders, a lot of the big institutions, the big hedge funds, we'll call them large traders. When they start to get long natural gas, that's when we start to see natural gas prices start to go back up. Now, they started decreasing their exposure going into last year, just before natural gas prices peaked. And now they're starting to increase that position, and they've actually started going net long again natural gas. And what this tells us is we might start seeing natural gas prices, start going higher again. Now, we are still looking for price to begin to confirm that. We are starting to see a little bit of a bounce here recently, but these natural gas can be extremely volatile. So we'll see a lot of ups and downs in the meantime, but we are seeing some of the bigger players in this market start to get interested again in natural gas. We'll see if that continues in the coming weeks, but we are starting to see them turn, and we can see that by the green line on this chart, which shows us their net position. It went from being net short, where they were betting against gas, to start going up to where they're now long 68,000 contracts of natural gas futures, which is positive for natural gas potentially going higher. Something for us to watch if natural gas starts going higher, a lot of the other energy commodities start going higher, that again is going to put pressure on that inflation data. And it's really, like we said earlier, the Fed's going to be in kind of a tough spot if this data starts to rise, and their plan was to pause this summer.
Yeah, I know. I'm watching this, Andrew, and it's got a lot of implications. It's got it for inflation. It's always striking when you've got producers of any commodity who become net purchasers, right? If you're a farmer, you're usually going to be a seller of corn futures. If you're an oil producer, you're going to be selling oil. So when they actually go to the trouble of actually getting long on it, I'm always thankful for it. And you bring that to our attention. But as a consumer here, I've got to brush up on the chart and the correlation between nat gas and propane gas, because they're here in the summers when at least we under the co-op get the opportunity to purchase a year's worth, or how many ever gallons worth of propane. So, not a large trade. I'm a very small trader, but perhaps I'll need to watch it over the coming weeks and get with you, see if I need to lock in this year's prices or not. So
Yeah, we'll
Hey,
talk.
thank you all for, you got it. Thank you all for sticking with us here for this week's Market Carver. Don't forget to give us a call if you think we may be of help. 800-928-4001. We look forward to hearing from you soon.